ton of news going on around the world today, and luckily for us, London Bureau Chief Martin Baccardax still here.
Here all week.
See, so we'll be doing this all week.
Waitress.
All right, we got to start with the IMF. Tip the waitress. We did the IMF, just so people know, made up of 189 member nations. They make decisions about monetary policy around the world. They lowered their growth prospects. Why?
This is interesting. Every once in a while you get an international authority that basically crystallizes what we've all been saying for a number of months now. And the IMF did just that today. They upgraded the World Economic Outlook. They cut their global growth forecast for this year and next for the entire economy, and actually made reductions for, most importantly, the US and China. And essentially what they said is what we have been reporting for several months now. There's going to be an issue with respect to trade and the tensions between Washington and Beijing.
Right.
And the impact of US fiscal stimulus, and by that I mean tax cuts, is going to fade next year. Tracy, you've been talking about that for weeks now.
Yeah.
So what they're saying is when that pulls back, we're going to get reductions in GDP growth, and as a result, we're going to see a concurrent slowdown in the smaller economies outside of China and the United States. I think this is interesting because not only does it say what we've been talking about, but it comes this week as the US Treasury is trying to borrow an extra $230 billion to fund those exact stimuli that the IMF says is going to fade next year. So you could argue that the Treasury is borrowing now for what isn't going to grow the economy next year. That's never a good position to be in.
Not even a little.
Yeah.
Expected to grow 3.7%. That's down 0.2% from their anticipated numbers. Speaking of the IMF, they always put numbers out on the effect of climate change and how these hurricanes affect us and cost us economic dollars.
Amazing.
Michael again, Hurricane Michael hitting the coast again. We have more and more hurricanes, it seems. How does this affect jobs at the end of the day? Well,
this is really, I think, the key issue that we need to look at right now. Beyond the economic damage that these things cause and the human damage, which we should never mitigate, we're looking at a very active hurricane season, which is probably going to disrupt the pattern of job creation in the months of October and November. It's already done so in September. Hurricane Florence changed our assumption for the number of jobs that were added to the economy, and that's why last week's data was a little bit softer than we expected. And it's why wage data was softer as well. So if Hurricane Michael has a similar impact in the November reading, because the October number is going to bounce back as a result, the November reading may fall, we may not get the true picture of job growth and, more importantly, wage developments until December. And again, that's going to be well past the time that the Treasury has funded most of its needs for the year.
After the midterm elections, more importantly.
Midterm elections, and during this concurrent rise in bond yields, which has disrupted global markets all over the world.
For sure. Interestingly, though, we often find job creation later on, sadly, as a result of these hurricanes.
Yes,
construction picks up, trucks, things like that. There's purchase power going on after hurricanes. So we do see the numbers pop.
Creative destruction, as the economists call it.
For sure. All right, speaking of destruction, Google's been having some issues lately. They had this hack back in March that they didn't say anything about, and now they're talking about shutting down Google+. Does anyone use Google+? I'm not even sure.
All 20 people who used it were devastated. 500,000 users is what Google+ says are going to be shut out of this. But what it is it's a reaction to another privacy and another data breach that has been disrupting the tech industry for a number of months now. And in many respects, what it does is validates the GDPR regulations, which the Europeans of all people put in place earlier this year, and which the industry has been pushing back on for a number of years now. But Google is the latest. Facebook has had similar issues, and so is Twitter. So the tech companies are demonstrating that they haven't gained our trust in the way that they keep our data, and we know that data is what drives their business model. Now, I argued a few months ago that data is going to be the new big tobacco issue for the tech industry.
No doubt.
And at one stage, people are going to swoop in with major implications from a financial perspective, where the government is going to claw back potential damages as far as this is concerned.
And maybe it's high time we get those GDPR regs here at home.
Well, Google didn't even bother to turn up to speak to lawmakers on Capitol Hill last month. And here they are in a major...
Twitter and Facebook did.
That's exactly right. I think they're going to capture the headline sequence today as a result of the release of the new Pixel phone, which is interesting, and it's actually probably cheaper as a result, cheaper compared to the iPhone. But nonetheless, I do think that even though they will get a likely spike as a result of the new product launch, ultimately investors are going to be looking at whether or not these companies are able to handle the data breaches and the security. And our Jim Cramer has said that their response so far has been suboptimal. That's a very polite way of saying they haven't done a good job at all, and they're going to have to do significantly better in the coming years.
For sure. Not so good at all, right? All right, stay tuned. The Street will be covering this wall to wall. Pay attention to Martin while he's still in town.